Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Alexion Pharmaceuticals, ticker ALXN. In the next 5 minutes, I will go through how I value this company and how I think about the quality of this business. Stay tuned and let's dive right on in. First up is industry. This company is in the biotechnology industry. So let's look at the business description to give us a little bit more detail. So they develop and commercialize therapeutic products. This sounds like pharmaceuticals. They offer treatment for a lot of stuff I don't understand. Uromatic syndrome. Let's see, they have quite a few things in clinical trials. Serves, distributes pharmacies, hospitals. Okay, so this is a drug company, specifically biotechnology drugs. Beta 1.25, so we have a relatively higher than normal volatility and share turnover of 500%. This is huge. So it means not only are you going to have high turnover in the shares, high beta, high volatility stock, likely means a highly cyclical business. So let's see how that looks on return on invested capital. Common for a biotechnology during startup is they lose a lot of money. So we're going to ignore everything before 2008 when they started to earn revenue. And just look at this time since then. So in 2008, 9% return on invested capital. They peaked at 54% in 2009, then 12, 17, 15, 10, 21. They had a really bad period from 2015 through 2018, managing to eke a profit every year. But their return on invested capital has dropped significantly since 2014. I don't know if their drug went off patent or something like that. But not great returns here. They had really good returns in between 2009 and 2014 and okay returns since then. Not looking good here, but otherwise they've avoided losing money since 2008, so I really like that. 10-year median returns, though, return on equity of only 8.4%. All of these returns are too low for me to get excited about investing. I want them all to be double digits. I want return on equity to be 15 to 20%. That's what gets me excited. The PE of 60 is way too high. I like to buy stocks with a PE of 15 or less. Willing to entertain something in the 20 or 30 range, but once you get over 30, it's just completely unreasonable. The only way you can justify a high PE ratio like this is if with high revenue growth, which they have. So high revenue growth, 27%. If you were able to continue this for another 10 or 20 years, you could justify a price like this. But that's very hard to predict. Unfortunately, what you're seeing is assets are growing faster than revenue. Assets are growing faster than EPS. And EPS is growing slower than revenue, so that means they have reverse operating leverage. The company is investing way more than they're getting out of their EPS, and that's going to continue as long as assets grow faster than revenue. You'll continue to see EPS decline relative to that over time. Now, this is the number that needs to grow in the 20 or 30% range every year in order to justify PE ratios like this. So you have a mismatch here. We need to look at gross margins. Now, common for pharma companies producing drugs, you're going to see very high gross margins. Basically, the first pill or the first treatment will cost billions of dollars and the second one costs pennies. And so you're going to see gross margins 88%, 93%, 88, 92, 91. This doesn't tell you a lot. Operating profit has 10x'd over the course of the last decade, which is really, really, really good. Again, if you could do that again in another decade, you can make a lot of money doing that. However, EPS is all over the place. They went from $1. They had $10 in 2019, but only $2.72 last year. So something really weird here is going on with their returns. Let's see if we can figure out some more information from the balance sheet or income statement. So they're diluting you over time. You have 183 million shares to 220 million shares over the course of the decade. That's not great. But you do triple your earnings in a decade. If you triple your earnings in a decade, that's a good way to get a good return, assuming you don't pay too high of a price. Something weird happened here. What is this? Why do you have such high net? So this is something really weird. So you basically had an income tax rebate. Your net income is way higher than anything else, and that's your revenue got boosted to 4.5 million. Something weird is happening. These numbers don't add up. So I think this is being miscalculated. The returns are worse than they look on this website. Long-term debt, you have 2.4 billion in long-term debt. How big is the balance sheet? So that's pretty low. That's not a big deal for this size of a business. Let's go to cash flow. So again, positive cash flow from operations every year. That's good. They don't need a lot of money into PP&E. They put it all into research and development. So you can actually have something that looks really attractive here. So it looks like they're spending money on acquisitions. That's common in this industry. It's really hard to evaluate. The problem is it's really hard to do these analysis on pharmaceutical companies because unless you know the individual pieces and you know what that looks like and when they're coming off patent, it's really hard to predict long-term returns. So the best way you can predict it is looking at the past, and the past doesn't look good. The only reason they're able to grow faster than their returns on capital is if they dilute you and they raise debt, and they've done that. So they've diluted you constantly over time. If their valuation was lower, then they would be diluting you even more than they did. So it means if the valuation ever comes down, you're going to have a double whammy. You're going to get your returns cut because you're losing a multiple expansion, or you're having multiple contraction, and the dilution is going to grow. So basically, if your PE gets cut in half, instead of diluting you at 3 or 4% a year, they'll dilute you at 6 to 8% a year, and that can really kill your returns when you add multiple contraction on that. So there's a lot of risk here. I would much rather see companies self-fund their growth, and all you have to do to analyze that is if these numbers are higher than these numbers, so if your 10-year CAGR is higher than your 10-year median returns, that means you're diluting and you're raising debt to do it. You're not funding it from cash flows, and so that's the biggest risk here. I would pass. I don't really like the biotechnology or pharma drug industry anyway, but I would pass because they're not self-funding their growth. If they self-funded their growth, this could be really attractive because you have high gross margins and stable margins. You can have a good business in this industry, but that's not what management is doing. So thank you for listening. Hit that like button in order to help me out, and don't forget to subscribe and hit the bell in order to get notifications for future videos. Thank you for listening, and until next time, stop paying fees and start building wealth.